Let's get to our ETF Spotlight this morning. It is on oil. The XLE, XOP, and OIH ETFs all slightly lower this morning after Tuesday's nearly 5% drop in oil prices, recouping a bit this morning. But between U.S. supplies and geopolitical tensions, what's the crude reality for oil in the second half? With us now, Stephen Schork, editor of the Schork Report, and here at Post 9, Jason Bordoff. He's the former White House energy advisor to President Obama and founding director of Columbia's Center on Global Energy Policy. Welcome to you both. Jason, I'll start with you. So bring us up to date. Following the OPEC meeting, we got the formalization of this alliance with Russia, affirmation of a 9-month production cut, and yet oil drops 5% on the news. What does that tell you in terms of the supply-demand setup structurally?
The bearish macro fundamentals are just overwhelming the market right now. The supply tsunami that everyone expects to be coming, especially in 2020, is overwhelming the market. So this is clearly not what OPEC was hoping for. They announced a production cut that was preordained from G20. It was announced by President Putin. That's significant in and of itself. But they go out of their way to say we're going to do it for 9 months, not 6 months. Khalid al-Fallah, the Saudi oil minister, in his press conference to say they want to use tighter inventory numbers. So they're going to try to bring the market down even more than people think. And notwithstanding that, oil sells off just because there's too much supply coming next year.
And this supply that you talk about coming next year, is it simply just not really responsive to prices, or are these levels sufficient?
These levels are more than sufficient. And that was another interesting thing. I think it was most interesting because the outcome was mostly preordained about the OPEC meeting was the messaging around it. And one thing was about the inventory levels. The other thing was that Khalid al-Fallah said very clearly, we're sort of recognizing that our strategy is going to allow shale to continue to grow for many years to come. And we're taking a long-term view of that. We're going to balance the market and support the price. And we know what that's going to mean to allow shale for several more years to run its course. So this is just a huge challenge for OPEC that they're having trouble dealing with, given that Venezuela and Iran have already more than done their part to offset some of this. There may not be other supply disruptions that large coming. They're going to have to do additional cuts potentially.
Stephen, are there other wrinkles here in terms of anything that would impel a further upside move? It was actually an interesting setup for WTI. You had this pretty sharp break down toward 50 and then recouped about half of that loss before rolling over a bit here. What do you see at work?
Well, certainly, I think the biggest issue here is the demand side of the equation. When we look at the last 5 months of 2018 and the first 5 months of 2019, we're looking at the OPEC 11, that is the OPEC countries that were bound by the original agreement to take 1.2 off of the market. We've had about a 90% compliance rate there. So the OPEC 11 in the first 5 months, again, relative to the past 5 months, have taken about 1 million barrels a day off of the market. To Jason's point, Iran and Venezuela certainly have done their part. They've taken an additional 800,000 to 900,000 off of the market. The U.S., meanwhile, has only put an additional 300,000 onto the market, and yet prices today are still about $20 a barrel lower than where they were in September. So clearly this is a demand narrative at this point. So with regard to price, we're fairly comfortable in saying that the price for a U.S. producer on average is about $48 a barrel. So earlier this month, we did get down to the low 50s. From an oil economic standpoint in the U.S., the market is at the bottom. That's not to say that we can't go lower. But certainly, if oil prices are to rally, they better rally now. It is the 4th of July. It is the start of the peak demand season for gasoline. If oil prices can't rally now, you have to ask yourself, when are they going to rally? So clearly, from a upside potential, there are a lot of hurdles still to overcome.
Jason, you mentioned that Iran's done its part in terms of, how all this is playing out globally with production. Meantime, you've got Iran's president warns that Tehran will increase its uranium enrichment to, quote, any amount we want. How big of a risk is that to the market?
I think it's a bigger risk than the market appreciates right now. And when we say Iran has done its part, what we mean is the United States has done Iran's part for it, because the U.S. is taking Iranian barrels off the market much more successfully, I think it's fair to say, than many people anticipated the U.S. could do unilaterally. And I think when you take Iran not to zero, but this close to zero, the economic pressure within Iran is so great now that they have to find a way to get Trump out of his comfort zone and change this status quo. And they're going to continue to do pinprick strikes, raise the level of enrichment of uranium. We'll see what happens July 7th, which is the deadline they gave the Europeans to find some way for them to get some relief. If Europe can't do that, they're going to escalate further on the enrichment side. And then the potential for some additional drone strike or something to sort of get out of hand in the Gulf, I think is real and more than the market appreciates. Because there's not a viable pathway to negotiation now. So this president wants to have a maximum pressure campaign on Iran, but doesn't want military conflict. Those two things can't both be true unless there's a pathway to negotiation.
And, Stephen, the fact that we've gotten not really any price response to all this, I guess, just reinforces the point that demand is just not there to soak up what we have on the market.
Yeah, absolutely. I think the two provocations by Iran, first the mining in the Gulf of Oman, and then, of course, the taking down of the drone. The market did not react to the first event. Market slightly reacted to the second event, but we quickly recovered. Trump right now is not taking the Iranian bait. The Iranians are clearly in a corner. They're striking out, trying to cause a rift, to try to juice prices. But the market is really giving it, to Jason's point, a maximum of minimum concern right now. And certainly when we're looking at that, and what's interesting is when we look at Wall Street, speculators, when we look at their value-adjusted or their volatility-adjusted risk ratio, bulls to bears, the bulls are sitting on the sideline right now. So all it will take is a real event, and Wall Street will come charging out. Part of the reason why oil prices are mired now in this middling range right now is the speculators out of the market. Speculators taking a wait-and-see attitude at this juncture.
Finally, Jason, you were, I guess, Senior Director for Energy and Climate Change in the last month. That doesn't exist anymore, that job.
No, it does.
Oh, it does?
Yeah, there's an energy advisor at the National Security Council and the National Economic Council.
And climate change as well.
No, I don't know if climate change is in their title anymore.
I asked the question only because we don't talk about natural gas very often, but there has been, of course, a surfeit of natural gas in this country. There is an administration goal to sort of get coal back on its feet. Is that going to work, or are we going to continue to see this move towards natural gas? And what does that mean for natural gas prices?
Natural gas prices have been soft, especially globally. When I was in the administration, you had Asian LNG prices of $18, $20 per million BTU. We approved the export of natural gas terminals, and then now they're coming online, and we thought all that supply would go to Asia. It's getting crowded out because there's so much competition in the market now. So one thing that U.S. LNG exports are doing is help to create more competition, undermine the pricing leverage that countries like Russia have in Europe. In the United States, the headwinds, market-driven, not policy-driven, not Democratic Obama policies, the market-driven headwinds for coal are just too great for coal to overcome. So coal is in decline, with exports as well. But domestically, that's driven by cheap natural gas and increasingly by cheaper renewables.